Perfect. Good afternoon. It's wonderful to be with you today, and we have a great panel here to discuss a topic of everyone's concern, which is pricing in commodity markets and the uncertainty it creates, not only for investors, but also for the mining companies themselves as suppliers, as well as end users. Today on the panel, just to walk through the individuals with us, we have Roger Baxter of Southern Palladium. We have Chris Gratias of Goldfields. We have Randy Smallwood of Wheaton Precious Metals. We have Nicholas Snowdon of Mercuria Energy Group. And finally, we have Chris Maybury, founder and chairman of the Primary Commodity Fund. Thank you all for being with us today. We're going to start out with a very straightforward question, which is, what's really different about today's environment from a pricing perspective? There's always uncertainty. What really makes today's uncertainty different? Maybe starting with you, Roger.
Jeffrey, thank you very much, and great to be here at FMF. Let me start off by saying that when you say what's changed in terms of complexity, in terms of uncertainty, the big issue in my view is pretty much this issue of complexity of issues, as opposed to, so we know what the uncertainties are, or we have a pretty good idea of the known unknowns. And how we manage them through the cycle, et cetera, on the mining space, whether we're dealing with it internally from a company perspective or whether we're dealing with the external related issues. But I think the world has become a lot more of a complex space, especially when you're dealing with the ESG issues or the EESGs, because if you don't have the economics up front, you don't have the environment, social or governance coming out of it. So I think the best way to define it, if you take a mine manager from 30 years ago, their set of skills is completely different to a mine manager of 2026, where you've got to really have the ability to manage the complexity of the uncertainties which you face.
That's great. Maybe over to you, Chris.
Yeah, thank you. And first off, really happy to be here. It's been a great conference and pretty exciting times. And I guess that's the point around, for me, it's not the price is the price, but it's the uncertainty of the price in a higher commodity environment, I think, creates increased uncertainty around costs. So it's labor availability. There's going to be a lot more money going into the ground. So how do you get access to the right people? Cost inflation. I think that also leads to uncertainty around, government and regulatory uncertainty, fiscal regimes. I think in this environment, everyone wants their increased share of the pie. So, we're seeing potentially changes to royalty regimes, tax regimes. That creates cost uncertainty as you're trying to make long-term investment decisions. And then, regulatory uncertainty, as we talk about, we see governments really focused on their critical metals strategy and how they can protect their own interests in that. So that regulatory uncertainty, I think, gets heightened in this kind of environment.
Excellent.
Yeah, I would just say, our focus, we're a precious metals company, but the bulk of our production actually comes from base metal mines. We purchase non-core precious metals from as a byproduct from these base metal mines. And so, just understanding market conditions, not forgetting the fundamentals, not getting caught up in market emotions. That's one of the biggest challenges is keeping it focused on the fundamentals. The comments in terms of community and the changes over the last 30 years in terms of what it takes to manage a responsible resource extraction operation has totally changed. In our company, we spend a lot of time not only on government and regulatory, but also community, making sure that especially when you're funding development, you got to have the community on side. And it's not enough to just go and visit with the friends of the operation. Whenever we do a due diligence process, we always have an outside team come in and try and find out, what's going on in the background in the local community. The hosts will always show you and introduce you to their friends in that community. And so community risk is incredibly important. You got to make sure that all the stakeholders are getting a positive benefit out of this, right? And that's the thing that I think really is changed over that. So staying on top of that, don't get caught up in the emotions of the market. As we see silver prices and gold prices at record levels, copper now at record levels going forward, just make sure that when it comes to valuing opportunities and making those investments, that you stay focused on the fundamentals. What is driving copper? They're all good, sound reasons. I spent 3 years as the chair of the World Gold Council, and everyone asked me, what's your favorite metal? It would always be silver, because the fundamentals are so strong in silver. And I look at today's market as just finally catching up to where it belongs to be. And so, it's making sure that you have an appreciation for those fundamentals as to what drives the market, and just try and back out the emotional side.
Yeah, look, I mean, I think that the last 12 months have been transformative for the metal space. I think the new administration in the US, has really catalyzed immense change in how these markets are going to function now and in the go forward. We are now clearly in a genuine era of critical minerals competition. For the last 25 years, it's been an arena dominated by China, and now genuine global competition has arrived. That obviously creates uncertainty and opportunity. But also we're in an environment where geopolitical forces are driving divergences and impacts on price that we haven't dealt with before. The broader theme of debasement, which has clearly been a very supportive aspect for metals pricing in the last few quarters. I think whilst that does create a lot of uncertainty, it creates a lot of opportunity in the space, and I think that's something that it certainly should be a focus at this stage. We're seeing a lot more money flow into the space. As a trader, we've injected nearly $3.5 billion in the last 12 months into the industrial metals supply side, particularly copper, and there are a lot of new opportunities trading commodities physically. The US is pulling in much more copper than it has in the past, and we think other commodities are also going to benefit in a similar light. So absolutely, immense policy change, transformative for market structure, and that creates uncertainties. But I also think that huge opportunities have opened up for the broader sector.
Chris?
Yeah, thank you, and thank you for inviting me to address these very important topics. And what's changed? The primary commodity fund, we think about this the whole time. And I think I'll make a couple of points. We spent 50 years building up internationalization and globalization, all of that to be shattered during COVID. Things changed so much. You could depend on getting things just on a phone call. All of that's gone. Overlay that, the geopolitical tensions and how metals now have become fundamental to what's happening in countries. And there's a lot of conversations going on around the world in that at the moment. You don't have to think too far for Greenland or wherever. I think the third thing is we have an increasing demand from all sorts of factors, which we'll touch on in later questions. But there's been a paucity of investment in mining, in discovery, in exploration, in investment. It hasn't happened for 25 years. And you can't turn on the spigot. In the US, a mine takes 29 years to come to fruition. So suddenly, with all the factors that I've said, we just can't keep up with demand. And I think that's what's created a lot of this uncertainty.
Yeah, and maybe a question specifically to you, Nicholas. Maybe you want to talk a little bit about the role that traders are playing in this uncertain time, and anyone who wants to build on that afterwards.
Yeah, look, I think, what role do traders play in industrial metal markets? They're essentially risk managers, both on a physical and price basis. Their role is to manage dislocations for the market on both physical and paper side. And so I think this is an environment where there is a heightened call on traders to serve that role. And I'd say there are probably three things that we've done, I think, in that regard. One is these new drivers of demand. As Chris was talking about, the US now importing significantly more copper than it has in the past. We've worked to facilitate that flow of metal into the US, which is clearly part of the kind of broader industrial strategy there. Second of all, the underinvestment in the supply side of metals is part of the reason why we're certainly in these very tight conditions. We've certainly been very front-footed, in this period of uncertainty, which typically restrains capital deployment, to invest aggressively. And we've had some very big recent deals announced in both the Copper Belt and in Central Asia, Kazakhstan in particular. I think the final thing that's important in this new cycle is also to play a role to support producer countries to kind of better capture value in this new kind of commodity bull cycle. And we've set up joint ventures with key governments, both in Zambia and the DRC, to really help them capture value from their equity stakes in countries, and to provide knowledge transfer on the trading side. So look, I think clearly heightened volatility and uncertainty, and I think that's probably a period where traders' roles are vital to kind of market function.
Perfect. Thank you for that. And maybe coming back to Roger, you talked a bit about how 30 years ago the mine manager's role was a bit different than it is today. I'm wondering if you talk a little bit more about how businesses should evolve to manage in this era of uncertainty, and how you're thinking about it from a business perspective, and then also just from a classic operations view.
Yeah, Jeff. So I think the most important part to state up front is that there are certain risks and uncertainties that you can manage, and when you can measure risk, you can manage risk. So I think one of the most important lessons that has been learned over the last 30 years in particular, and let me just go back to the comment that was made a bit earlier about communities. When you're working with communities who are part of a project, and communities which benefit from a project but are, as part of the project, evolving the project going forward, support the project. They'll be your greatest die-hard supporters if you can get them on board. So it's exactly the comment that was made a bit earlier about, I think it was Randy who made the comment, working with communities. It's not just about going consulting communities, it's about involving them in the process. So, let me give you a practical example. I'm heading up a company as executive chair called Palladium. We are a development PGM company, Platinum Group Metals company in South Africa. This is going to be a genuine tier 1 asset. We'll probably end up employing some 6,000 people directly from the community. But right from the get-go, the community, this is almost like a model example of how this can work. The community own a 30% equity stake in the company through their Bengwenyama Traditional Council, which is the council that represents the community. They sit on the board, the underlying mining asset board, where there's 50-50 representation and chaired by the community member. The CEO is appointed by us. And just to make the comment, at every single stage in the evolution and development, whether you're dealing with skills development, whether you're dealing with procurement, services, mine planning, and then the longer term issues that relate back to the community from an infrastructure perspective, how we can take the benefits out of the mining operation at the same time for the community in terms of skilling youngsters in the community.
Yeah.
And then working with the other mining companies in the area. We have a structure close by called the Southern Cluster, all the mines in the area working together on skills development issues, on community development issues. You can achieve a lot more through that sort of economies of scale. And so I think we've learned a lot as mining companies in terms of how we manage the uncertainties and make sure that the community, the Bengwenyama community in our case, are our true economic partners in the project. And that's just a fantastic way of managing the risks in the project.
And maybe Chris, for you, maybe talking a little bit about how you as a company are also be able to manage all of the price volatility. It obviously must really, make some of your financial models go haywire when you're thinking about new investments. So how are you managing that?
Yeah. So it's very much a dynamic environment. So as you try to budget and plan the year ahead in this type of situation where prices are moving as quickly as they are, I think we take the philosophy, you have to manage to the downside. So it's continued focus on cost, and then not chase the price, and look at going after higher cost ounces, bringing up the overall cost of your business. You have to protect against the downside. And then in this price environment, you have an excess margin. So how do you deploy that excess margin? And I think it's such a unique opportunity that we can invest in our business to really future-proof our business. It's a chance to do that, put more money into the ground, So that's kind of how we think about it, how we're going to invest that excess margin for the future. I think that leads to the other, big risk. It's not a new risk, but I think it's accentuated in this is around just talent. So I think we have a big focus on how are we going to develop talent internally, attract the best talent. But I think as an industry, this will be a huge challenge going forward and I think we all have a responsibility for this, is how do we get more people into the industry trained up so we have highly skilled, qualified people to build and execute these projects as more money goes into the ground over the next 5 years.
That's great. And how about you, Randy? How are you seeing it?
Well, in a sense, our business model is there to manage price volatility. And so it's what we provide to our shareholders is that cost confidence, at least when it comes to cost volatility. And I would argue that our shareholders invest into us to get exposure to the commodity price volatility. More recently, of course, very, very positive. But that's the whole focus of the business model is trying to minimize that. Chris made a good comment about managing to the downside, right? A wise, one of my mentors, Ian Telfer, part of building Gold Corp and part of probably the leading guy in terms of the creation of the streaming business model. I love the way I started off working for him. I'm a geological engineer by background, and my specialty was always project evaluations. I actually realized, I was sitting there thinking about it, I was that mine manager 30 years ago. I was managing a mine up in northern Canada. And so I had the operational background and then the project evaluation specialist. And I always remember what Ian said. He says, it's easy to find a mine to invest into. The trick is finding which mines not to invest into, which projects not to invest to. Manage to the downside, right? Look at it and try and uncover the risks beforehand. And we've built Wheaton around that principle. I use a phrase, and not to take anything away from how important people are, but when we're making a long-term investment, people will change. And so, the phrase that we use internally in our company is, looking for management-proof assets. And to steal a quote from a number of different people, invest into foolproof companies, because inevitably a fool will run those companies. And you want the company to be able to survive that whole process. And so we really do sort of manage to the downside, just to again quote Chris on that. And it comes down to trying to identify where the risks are going to be. The other principle that I think has differentiated Wheaton, especially compared to some of our peers, is that we put a real focus on how profitable our partners are, the operators are. And we monitor, we visit the sites on a regular basis. We get full access to the financials and how the asset's going, because if there needs to be a change, we're a partner in this. And so if there needs to be a change to enhance profitability, if there's some risk that needs to be supported, we're happy to step in and help out from funding studies to modifying agreements. We're not healthy unless our partners are healthy. And of course, none of us are healthy unless all stakeholders are healthy and benefiting from this. And so it's really about trying to identify those risks early on. Our company is built on solid, I mentioned in my first comment, fundamentals. 40% of our company has a technical background of some sort: geologist, metallurgist, engineer, social scientist, political risk specialist. That's how important that we put that in front, is trying to focus on the asset, focus on the community, focus on the stakeholders, and make sure that we're doing the best we can as a partnership to unlock the value and deliver a good, solid product to society.
That's great. Maybe to Nicholas, how's your business evolving? Obviously, your business is built on risk as a trader. So.
Yeah, well, look, I think we're a relatively new metals business. Mercuria has been a long-standing energy trader. It's the third largest private kind of energy trade house in the world. So on the metal side, we're in a rapid growth phase. We see immense opportunities in the markets here to kind of capture share and value. Within the last 12 months, we've become one of the top 3 largest copper traders, having been a new business essentially in mid 2024. But I think volume alone isn't the sign of success. I think our ambition is, to grow a long-run business, and that's, where the kind of capital deployment that, we've executed this year in particular is crucial. That $3.5 billion, really shows a commitment to, to the next kind of 3, 5, 7 years in terms of, the kind of mining projects that, we're supporting and looking to kind of trade volume on. So I think that, from a business perspective, it's about growth and a lot of opportunities in the market space in the context of the kind of critical minerals policy backdrop that we see today. So much more interest in the sector and capital, and I think playing a role to sort of support that growth is exactly what we want to be.
Perfect. Maybe Chris Maybury, if you want to comment on that as well, in terms of how your business is evolving to manage this level of uncertainty.
No, look, thank you. And at Primary Commodity Fund, we view what's happening now a little bit differently. We think that there's been a lot of talk at this event about us going into a super cycle, and we think we are going into a super cycle, but this super cycle is going to be different. And I'll quote Amanda Van Dyke, who says, this super cycle will not be defined by abundance, but by constraint. And I think the economies that are going to do well will have a supply. A supply of what? A supply of these critical minerals that we're talking about. Who ever thought we'd have the President of the United States talking about critical minerals every week? Frankly, we all know here that a lot of the things and solutions that are being proposed might be right, but they're at least 10 years away. So at Primary Commodity Fund, we see ourselves, as opposed to butterflying from issue to issue, we have a laser focus, and we think that as opposed to us trading metals and buying metals, we are trading industrial intelligence. We're researching what's going on in the world and where, trying to see how the miners and many of the people who are doing a fine job here, their supply can be applied to allow industries to thrive, electrification to happen, defense to be built. And I think the role that we are playing at the leading edge of what's happening is vastly underestimated. And I actually think that we do a very poor job of explaining to the world how critical we are. Do you know, if you added up every mining stock in the world, add them all up, private, public, it's 25% of the value of NVIDIA. But NVIDIA can't exist without us. We're doing a poor job. So at Primary Commodity, as I say, we're not butterflying around, laser focus on what we can do to build these economies so that they can flow and are not constrained.
Perfect. Thank you for sharing that. We're going to go to some rapid fire questions at the end. So maybe we want to keep our answers to maybe 30 seconds max. I'm going to go through one by one. Tell me, which commodity are you most bullish on in 2026? Roger.
Platinum group metals. And just to say, ruthenium was the best performing precious metals last year, up 158%.
Okay.
Platinum up 119. So yes, PGMs is a suite.
Excellent. Chris?
Yeah, I have no choice but to say gold.
Yeah, I was going to ask if you had a byproduct you were interested in.
But yeah, if I say not my own commodity, I continue to like the dynamics that we're seeing in the copper market.
Copper market.
Yep.
Perfect.
I think I've already said silver.
Silver.
Silver conducts electricity better than any other metal. Highest conductivity, lowest resistivity of any other noble metal. So the more silver we use, the better the world is. There's no more metal more critical than what silver is. It has strong antibacterial applications, increasing industrial demand. More than 2/3 of silver is now consumed in high-efficiency electronics, mobility, antibacterial applications, all the way across the board. And now we've got precious metal investors coming in. Silver, all the way.
Yeah, look, I think copper would be top of our list. I mean, I think you've already seen incredible velocity of move over the last couple of months. I think that's largely been driven by money flows. Really, every metal has risen because of this broad speculative engagement. I think the fundamental support for price really lies ahead. Now we need Chinese demand to sort of catch up a bit with the price move, and that will take a bit of digestion over the next few months. But once China's more front-footed, you still have this very strong pull of metal into the US and severely constrained supply side. Those ingredients really do combine to a real kind of period of tightening and sort of scarcity risk in the market perhaps more towards the second half of the year.
And critical minerals are so, holding 21 in your phone, such tiny quantities for the world. They're varying between 100 million and the biggest one's 3 billion. Tiny quantities the world needs to survive. And so those inputs are no longer an input to industry. They are the levers for society to have security, prosperity, and power.
Perfect. And maybe passing it back, one word of reflection to talk about last year in 2025 in commodity markets, and one word for next year. So maybe we'll start with last year. Roger?
So we only allowed to say 2 words.
Yes, exactly.
Well, so let's say last year, exciting. 2026 would be more exciting in one word.
Perfect. Excellent. Chris?
You sort of stole my thunder a little bit there. I was going to say dynamic,
Dynamic.
and then very dynamic. So
Exactly. Great.
I'm gonna break the rules here a little bit. I'm gonna say that 2025 was the year that we were reminded that gold is not a commodity, it's a currency. In 2026, it's going to be further reinforced. It's a currency.
Yeah, I mean, I think
Great,
25 was transformative, given the kind of policy shock we've had take place. I think 26 is going to be a year of volatility.
At primary, we saw 25 as chaos and 26 as opportunity.
That's good. I mean, that's definitely more of a glass half full perspective. That's good to hear. And maybe just, is anyone here comfortable sharing a price outlook for the commodity of interest?
Why, of course?
Yeah, let's talk about silver. Randy, please.
Well, it's funny because I did spend some time on a couple of the bigger news networks out there, and about 2 weeks ago I was forecasting $100 silver and $5,000 gold by the end of 2026. I'm now thinking it's going to be the end of January that we start seeing that. The movement in precious metals hasn't slowed down, and for a number of different reasons. And so I'm still very bullish. I'm trying to find a bearish aspect to what we see, but as long as we measure things in US dollars or fiat currencies as a whole, but US dollar being our main reference currency, I just don't see anything but continuing weakness in the US dollar. And so it applies to copper, it applies to everything. It's the measuring stick that we're all using, and the collapse of that measuring stick, the lack or the loss of independence of the Fed, which is one of the reasons that the US dollar has stood as an independent reserve reference currency for so many years. I think we're going to head back to a gold-pegged currency of some sort. The technology exists that it actually can be gold. Digital gold is coming, and we'll get back to tokens. Everyone wants their currency to be abject to political influence, and that's the only way we can go. So my 5,000 seems kind of light. I think a friend of mine, everyone pretty well known, Pierre Lassonde, his calculations to rebuild the relationship that we had in 1970 with the US dollar and gold would indicate that gold needs to be over $17,000 per ounce just to reestablish the relationship that the US dollar had with gold in 1970. So, somewhere between 5,000 and 17,000. It's a good range.
Perfect. Roger?
So Jeffrey, I think, when you think about these suites of metals that you've had the input from Randy on the gold side. If you're looking at platinum group metals, structural deficits, supply over the last 10 years has gone south from a new mine supply perspective. Not a lot of new investment in mining. Price was in the doldrums pretty much for a decade. But the industrial applications, jewelry applications, and catalytic converter applications, and increasingly the hydrogen applications have all continued to grow. And then some of the metals like ruthenium, hard disk storage technology, relies on ruthenium in the resins. That's why the ruthenium price is up over 158% last year. And that's because of artificial intelligence growth, et cetera, et cetera. So when you think about these, it's not just about the fundamentals between supply and demand and the fact that these are all now mostly in structural deficit. It's exactly what Chris was talking about at the end, which is we're in a super cycle where there the undiscovered ounces are much more difficult to discover. And so the new mines that are going to come on are going to take longer. They're going to be, quite a few of them, low quality, apart from Southern Palladium, of course. We're still gem quality from a mining perspective. And so I think it's important to put in mind it's much more difficult to bring on stream the types of assets that have been brought on stream over the last 30, 40 years at a global level. And so it does create a lot of opportunity at a mining level, and I certainly subscribe to exactly what Chris was saying on this view that mining is going to catch up with the rest of the world from a valuation perspective. The economic value of mining has been severely undervalued. The commodities are now demonstrating where the value is going to go to, and the mining companies from an equity perspective are going to catch up. So without giving you a specific prediction on platinum group metals,
it's up.
They're definitely going up. Yeah.
Okay, very good. Any other price predictions?
Well, I mean, look, I think, looking back at the history of these markets, what ends bull markets, is a combination of supply responses, demand destruction, and kind of inventory releases. And I think if you look at those three factors right now, as we've all said, the underinvestment of the last decade means that the short-run capacity for supply responses is very low right now. And it's going to take several years of investment for that part of the story to change. So we don't have to fear a sudden wave of supply from price levels today. And on the demand side, it's very difficult to achieve end demand destruction with industrial metals. It has a much lower price elasticity of demand than, say, energy commodities, because copper, for example, represents such a small part of the cost of the goods it goes into. So copper going from 10 to 13,000 really has very little impact on the price of the car or the building that you're making. So demand destruction at an end level is very difficult to achieve. Midstream, yes, you get a bit of volatility, but that's fairly temporary. And finally, we don't have a huge amount of inventory in industrial metal markets. Since the beginning of this decade, particularly in COVID, you've had a kind of a deficit phase that's run down stocks. So look, I think no one wants to make a big call on price, but I think it's fair to say that with those conditions in place, the likelihood of this bull market unwinding in quick succession is very, very low, absent a global growth shock, which for now is not part of most people's base cases.
That's great.
Yep.
Chris.
Yeah. We'll give my view on gold, and I really want to echo some of the basis is really what Randy's talking about. Is gold as a currency, and in this environment, I find it very difficult to paint a picture of what the downside is, especially as the U.S. openly talks about weakening the U.S. dollar. So I think those trends continue. And the question is for how long that will last. So again, I say, what's the scenario where the current trend will stop? I will quote a survey. I saw a survey of a number of hundreds of investors. And this was when gold was about $4,000. And what was the outlook a year from now? And there were, I think, 15 times the number of investors that said gold would be above 5,000 by the end of 26 versus below 4,000.
We're seeing two or three really big trends, which I think are very interesting. I think the first is we have price-insensitive buyers in the market, like governments, and to an extent companies. They don't care. They don't believe they're going to get stock. If they see stock, they're going to get it. And countries are buying gold because they don't believe in US treasuries anymore, as you know. So that's one, price-insensitive buyers. Point two, we have never seen price floors being set. There are price floors being set for metals at the moment. We know those with MT, et cetera. So that is telling you what's happening. And those price floors are a long way above prices now. And the third thing is stockpiling. President Trump put through $2 billion of stockpiling for metals for the US. At the end of the Cold War, the US had $40 billion. $2 billion isn't going to touch it. The EU has announced that they want to stockpile. We are going to have, again, price-insensitive buyers who just want to buy everything they can get on the market. And we all, I think, don't have to be economics majors to understand what that's going to do to price.
And we're going to leave it there. I want to thank my panel for today's conversation. A lot of exciting price predictions for the industry, and looking forward to FMF 2027 to see how much they've panned out. Thank you all very much.
Thank you.